Hello, I'm Bob Chambers, and welcome to Trading Talk with Bob. This is a special edition report for March 15th, 2012, entitled America's Debt Crisis. Beware and prepare. Today we're going to take a look at what we believe will be the dollar's ultimate demise, our massive federal deficit. You know, today roughly 100 million Americans have their money tied up in interest-bearing CD and saving accounts that are paying about 1%. And with an inflation rate generously pegged by the feds at about 3%, the ship is on its way to the bottom, and quickly. This is all exacerbated tremendously by our continually increasing and ultimately unsustainable massive federal deficit. Under President Roosevelt, the federal government was 3% of the economy. Today, it's over 28%. And when you add state and local compliance agencies and all the businesses that support the government, it's over 50% of the U.S. economy. Now that's big government. So to get a better understanding of the enormity of the situation, we've teamed up with the Khan Academy to bring you this informative look at what we believe will bring the dollar and our present economy to its knees, and sooner rather than later. So please take a look at this, and we'll be right back.
What I want to do in this video is dig a little bit deeper into the deficit. And just so that you can get the data yourself, they're all available at this document, which is hosted by the Department of Treasury, so you know that I'm not making up these numbers. But just to review, the deficit is really a measure of how much you are overspending in any given year. And so if you look at the deficit, and I'm going to focus on 2010 in this video. In 2010, the government spent So the spending for the government in 2010 was about $3.5 to $3.6 trillion. And it brought in mainly tax revenues, but it has a few other sources, but mainly tax revenues, it brought in about $2.2 trillion. So based on this, the overspending, or the amount of money beyond which or the amount of spending beyond the revenues, or the deficit in 2010 was $1.3 trillion. What I want to be clear on is this is only one way to account for spending versus revenues. And this is not the way that most companies would primarily report their own income over the course of the year, or their own cost, or their own loss over the course of the year. Most companies would not just have to account for their cash outlays, and that's all we're considering in this $3.5 to $3.6 trillion. A traditional company would also have to include any other liabilities or any other obligations they're taking on. For example, if I hire you and I promise to pay you $50,000 over the course of the next year, and I'm going to pay them to you in cash, but I also promise that when you retire, I'm going to pay you $10,000. I'm going to give you a $10,000 per year pension. And on a traditional income statement, I would not just expense the $50,000. I would definitely put that in my expenses, and the government would put that in their expenses. But I would also have to account for this liability that I'm taking on. I would also have to say, look, in order for me to be able to afford a $10,000 pension at some future date, I'd have to make some estimates about when you would retire and how long you would live and what interest I could get on money and all of the rest. But I would have to say I would have to set aside some amount of money so that in the future I can meet that obligation. So maybe I have to set aside $2,000 this year and hope it grows properly over the course of the next 20, 30 years until you retire so that I can afford to pay you that much. Who knows? But I would also have to account for it right here, that extra liability. The government, in the calculation of the deficit, does not account for that extra liability. And it is taking on other liabilities. It is making these pension promises to government employees. It has obligations to the veterans and Veterans Affairs and all of that. And that is not taken account, or that is not accounted for in the deficit. It is accounted for in the gross costs. And you see here, we said when we look at just the budget, we're talking $3.5 to $3.6 trillion. That's direct cash outlays, or mostly direct cash outlays. If you include all of this other stuff, Then it balloons to $4.5 trillion. $4.5 trillion. So in a previous video, I mentioned that the government right now, for every dollar that it's spending, it has to borrow 40 cents of that dollar. But if you really think about the total obligations that it has, and the total obligations being 4.5 trillion it took on, viewed that way, it only has about half of that. It only has about half of that coming in revenue. So every dollar in revenue, the government is taking on an equal amount of obligations that year. Some of that is going to express itself in terms of increased debt, and some of that is just going to show up as increased obligations. And you can see both of those things are increasing year after year after year. And depending on who you talk to, which side of the political spectrum, some people will blame it on Bush. They'll say, look at this, the spending increased under Obama, which someone on the right would say, but then someone on the left would say, yes, but the spending increased because we had to do all these bailouts. The economy went into started to tank at the end of 2008. We had to do all of these emergency things. As soon as the economy tanks, the deficit position gets worse because you bring in less revenue. And not only do you bring in less revenue because corporate profits are down, fewer people are employed, people start earning less, but you also have higher expenses because all of these automatic obligations kick into effect. Unemployment benefits, Social Security benefits, Medicare benefits, those increase. So deficits naturally get worse. But the whole point here is to say, regardless of what party you're on, things are getting worse and they don't seem to be getting better. And generally, you'll always see this net operating cost. Sometimes the net operating cost will look lower than the actual deficit, like it did in 2008. And that's because there would be some type of actuarial or accounting re-estimate of the future obligations, maybe the pension obligations or whatever. But in most years, we're taking on more obligations than just our cash outlays. And that's why you see the operating costs so much higher than just the pure deficit right over here. And this chart right over here actually goes into what the difference is, the actual difference. And you see that it's mainly things like liabilities for veterans compensation, military and civilian employee benefits, government-sponsored enterprises. There's some downward revision of the TARP. I don't think you can see that. So all of a sudden you realize that the TARP is going to cost us more in the future than you thought it was going to be. Even though you don't spend that 86 billion this year, you realize that you have an 86 billion higher obligation. And so if you add all of these, or I guess you subtract all of these from the budget deficit, then you're going to get the net operating costs. And you might already find that depressing, but the point of this video is actually that's just the beginning. Because if you look at where we're going, the trajectory, it gets even more depressing. Because not only do we have this huge budget deficit, or these huge operating costs, this loss, I guess you could say, on an annual basis, but it's going to get worse, and it's going to get worse not just from the overspending, on the government programs and defense and all of that, but because our debt is increasing so much that the amount we spend on interest is only going to increase, and that just makes matters worse. The more you spend on interest, the larger your deficits, the more you have to borrow, the more you have to spend on interest. And this is a long timeline right here. It goes out to 2080. But it's pretty clear that something is going to give. So as a percentage of GDP, the government the size of the government has historically been around this, depending on different periods in history. But in the recent past, it's been in the 20% range. But if you just let things go the way they're going to go, and a lot of these are kind of mandatory spending, things we've already obligated ourselves to, or what we think we've obligated ourselves to, it looks like the size of the government's really just going to take over the economy. It's going to grow over the next 20, 30 years to 30%, 35%, 40% of the entire economy. Now, if that by itself is not scary or depressing enough for you, then we just have to look at this chart right over here. And we've already gone over some of this chart. This is the gross costs. This is the total amount we're spending, outlays, cash outlays, and other obligations we're taking on and accounting for it in some way in the present. And then you have the taxes that you're bringing in, and you see this is your net operating cost that we calculated already. And then it shows your assets, the assets of the government, mainly buildings and land and things like that. The government has a lot of nice land and buildings. And then you also see, and property, plant and equipment and all that, aircraft carriers, whatever you want to throw into the mix right over here. But then you see the debt. And there's been a lot of talk of the debt. But you might be saying, wait, even in 2010, right now as we hit the debt ceiling, we have like 14.3 trillion. But didn't we have like 13 point something trillion in debt in 2010? Why does this only say 9 trillion? That's because we had another 4 trillion in debt that is not held by the public. This is just debt held by the public. And the public includes things like foreign governments. But there's another 4 trillion that is held by the government itself. So that is not accounted for. And that 4 trillion is mainly excess funds from the Social Security Trust that are all invested in treasuries. But the government, in the end of the day, is responsible for the Social Security Trust, and so it is not accounted for right over here. So you have 9 trillion there. You have another 6 trillion that is seldom talked about, which is benefits for federal employees and veterans. That's right over here. So huge obligation. So a total of 16 trillion in liabilities. Now, if that by itself doesn't scare you enough or doesn't depress you enough, we just have to go down a few lines on this statement, and you'll see something that does. And this right here is the expected or the present value of the obligations for social insurance. And the way that they talk about social insurance, it's both Social Security and things like Medicare. So these things that we've promised we would pay to people in the future, or at least that we've told people that we will pay them in the future. And the present value, and the easiest way to think about present value, and I've done videos that go into a little bit more depth on that, is how much money, given some assumptions. If you assume that if I put money aside and that money grows at some rate, how much money would I have to put aside in order to fund those obligations? And this value is over the next 75 years. And I want to make it clear. You might say, oh, 75 years, that's, of course it's going to be a huge number. But remember, we're assuming that we can grow money. We're assuming that obligations that are 75 years from now, that if I have to pay someone $10 75 years from now, I don't have to put $10 aside. I might only have to put 50 cents or a dollar aside and assume that that 50 cents or a dollar will grow by some percentage so that by the time 75 years go by, I'll actually have that $10. So this is actually a discounted value. This is assuming that the money that you could set aside today, that the obligation today, that it would grow to actually fulfill the actual amount that you have to pay. And this should scare you. These are huge numbers. This closed group are what they call the current participants, and we could read the footnotes, includes current participants receiving and/or are eligible to receive benefits for the Social Security and Medicare programs ages 15 and over at the start of a 75-year projection period. So that's 43 trillion. Then open group, they have current and future participants. This is slightly lower because it's including people who are going to be paying into the program and not necessarily taking out of the program, but it's still a huge, huge liability. It's twice as big as the official liabilities that the government takes on.
Well, there you have it, $16 trillion in current total debt, with over $115 trillion in committed debt to future spending on Social Security, Medicare, and the like, all with a currently shrinking workforce and tax base. To get an idea of just how much these figures are, take a look at this. This is $1 billion in stacks of $100 bills. This is $1 trillion. This is $15 trillion, and this is $115 trillion in stacks of $100 bills. Now, just what would it take to cause this out-of-control monster to crash and burn? At this point, very little, it seems. Ben Bernanke gave us an indication when he said recently, the large U.S. current account deficit cannot persist indefinitely because the ability of the United States to make debt service payments and the willingness of foreigners to hold U.S. assets in their portfolios are both limited. In fact, foreign investors don't even have to sell their U.S. debt to make us insolvent. All they have to do is stop buying it. More to the point, soon the world will lose confidence in the U.S. dollar and will want to cash in all the U.S. treasuries they own. Interest rates will rise, and when that day happens, because we don't have the currency to pay up, the printing presses will roll into overdrive and the ship will begin its rapid descent to the bottom. Here's what David Morgan had to say about this recently.
I think you're going to see a different situation. I think 2 years from now, you'll see the middle class getting lowered even further. I mean, let me explain that a bit. If you look at the dollar in constant terms or in purchasing power, constant purchasing power, the actual average American's standard of living has gone down from about 1972. And of course, people listening to the show don't understand money or inflation, don't get it. Well, I was only making 12,000 a year in '72, and now I make 82,000 a year. It's a lot bigger number. But those numbers are just for the idea. The idea, that might put you in positive. I don't know. I'd have to do the math in my head. But the point is, you have a lot more dollars, but your actual standard of living is only maintained because you put your wife to work, and you got a second job, and maybe made a couple good investments. In other words, the purchasing power has continued to deteriorate. The average American's wealth status has actually gone down, not up during that time frame. And this is something that's critical, and that goes back to what I write about, money, metals, and mining. I keep pounding in my reports and in the public domain about the seriousness of this problem, because people often say, well, no one told us, or I don't understand. And you're not going to see me very often on CNBC. I do get on Fox Business actually fairly regularly, but nonetheless, there aren't a lot of people telling the general public, the investing public, the truth about these matters.
This is what John Embry had to say.
The underlying reason for why one must own gold and silver is the inevitable debasement of money because of a debt situation in the world to which there is no solution. And I went through each of the various economic entities that are important in the world today and tried to make the case that in every one of them it was a problem that could not be solved without either accepting a debt collapse or printing unlimited amounts of money to keep its insolvent banking systems and the bad debt afloat. My suspicion is we're going to go the latter route, and the implications for gold and silver in that scenario are huge.
Our politicians have put the American economy so far into debt that the only possible way to pay it is to print hundreds of trillions of dollars, and that can only lead to one thing: inflation, just like the 1970s and possibly much worse. And the roughly 100 million Americans with their currency and CDs and savings accounts that we mentioned earlier, well, they'll find that though their dollars will always be safe, the value or purchasing power of those dollars will be severely diminished. Inevitably, this broken fiat currency system will collapse under the weight of its own worthless debt and will ultimately be revalued into a more credible currency system backed by more than just government IOUs. Yet throughout history, there has always been one thing that has continually held value in all economic conditions and currency wars, and that is gold and silver. So please, beware and prepare. This is Bob Chambers for Trading Talk, wishing you a very good day, and please pay it forward.